with military unknowns in Europe is keeping one's asset liquid the best. Has anyone looked into any historical literature on how to best manage one's finances during the world wars or equivalent? And so, this is the tricky thing, right? But I think at the end of the day, this is what a lot of us are worried about right now in this moment is like, what do I do about it? And so, I did a little bit of homework, and Louise, I'll put a link in the chat. There's a guy I really respect, Ben Felix. They do a podcast called Rational Reminder, and he answered sort of this specific question. And so I'm just going to put a link to his YouTube on there. But that really, kind of what it comes down to is we don't know. The problem with wars is that everyone thinks that this one is different. And if this one is different, then you can write, send out the rule book. Like, you just can't. We don't know what's going to happen if it is different. Looking at the world wars, it's really bad for your stock market to lose a war. That when we look at sort of Germany, World War I and World War II, if we look at Japan, after World War II, like it was like those stock markets almost went to zero, right? Just because it was really, really hard on their economies. When it comes to the rest of the world, it's a bit of a mixed bag. World War I, stocks went down. So World War II, people tried to play that. They were like, oh, I've seen this before. Okay, I'm going to get out of stocks. They're going to go down. Stocks actually ended up going up. Like, it's really, really weird. But I think the biggest thing that came out of the research that he did is to show that the biggest drawdowns, and there were drawdowns that happened during each of the wars, like at some period in time, there is kind of a panic or a fear, things do come down. But they're actually a lot smaller than any of the purely financial crashes that we've had. That any of the dips or the declines that we saw, looking at it from a global stock market perspective during major wars, weren't as bad as 1929, weren't as bad as, what was it, the oil embargo and, rapid inflation in the 70s, weren't as bad as the dot-com crash, weren't as bad as 2008. That those were all worse crashes than even the biggest ones sort of from the war. So again, just want to go back to our point at the top of the show where, someone had cash, like this is always the question, well, what do I do about it? And I think we want to be clear that our mantra is sort of stay calm and rebalance. That really, you don't really need to do anything. Don't try to play it. Don't try to guess. That's kind of the worst thing to do. It's really just stick it out and let's see what happens. If it's the worst case scenario and like nuclear war, then it doesn't matter where your money's invested. Like, we have bigger things to worry about in that scenario. But most of the time and all other times, things have come back up. Things have sort of like improved. And certainly if you're in it for the long term. And that it's not, I don't think, super necessary to keep a huge amount in cash. It might make you feel safer, but having cash, it doesn't really do too much. And then the last thing I want, Darryl, for your opinion on, is this tension right now that I think people are, number one, really nervous and are afraid. So they want to be in cash or they want to be in bonds or like these low risk things. But we do have inflation now, which is higher than normal, which means that if you're in cash, like you're losing money to inflation. Even bonds, like the returns aren't really high enough in real return that, people want low risk, but they also want a high return to beat inflation. And I think at the end of the day, like, you can't have both. Is that fair?
You can't. You can't. And so I would push back a little bit on the notion, and it's very much out there that inflation is, and you pick the number because it's done, depending on the month, but it is a year-over-year retrospective look. So when we hear the headlines out there of inflation being 6.3, 7%, people ought to really know that that number is real looking. So you're looking at the price changes from a period of time where the economy was partially frozen, the global economy is partially frozen, to a period of time where things have opened up. So inflation is going to run fairly hot. Now, I think the really interesting thing that's happening right now is trying to figure out what the trend is. Are we going to remain at 7% inflation for forever and forever? I don't think so. I think inflation is actually going to start falling. That doesn't mean inflation is negative. It means that the year-over-year changes are going to start to decline back to trend towards their normal levels of around 2%. They're not going to hit 2% overnight, but I think actually the change in inflation is going to start slowing down. What does that mean for investors who are looking for a safe place to store cash? It means that you're still in a really low interest rate environment, but I think if you really want to make an assessment about holding bonds and really more accurately factor in the idea of inflation, you really don't know what that number is, because your return is going to be your interest payment from now versus 1 or 2 years or however it might be, but you don't know what inflation is going to be from now over the next 12 or 24 months. Yeah. And it could be flat. It could be, a little bit more normal. It could continue to clock in on, at 6 or 7%. But again, when you hear those numbers, that is not current looking forward inflation. That is inflation from March 2021 to March 2022.
So and March 2021, prices were very, very depressed. Demand, everything was so we're coming from a low benchmark. So those inflation numbers, and I want to be clear, inflation can be a problem if it's like hyperinflation, if it gets out of control, but that's more of a psychological, that's more of a behavioral, everyone starts acting as if prices are going to keep going up, right? And so it's almost like a self-fulfilling prophecy, this idea of hyperinflation. I don't think we're in a period of hyperinflation. I think to your point, A, we're coming from a very low place, and that B, that right now, because of global supply chain issues, like there's a microchip shortage. I was hearing about a potato chip shortage, like the real chip shortage. People were worried about that. Like now wheat and, with Ukraine and Russia, like fertilizer, like definitely like prices are going to go up. But keep in mind, these things do have, over time, if we're looking at it, over the next 5 years, 10 years, I don't think we need to worry about hyperinflation. That really it just is, understanding that there is a repricing of everything happening in the world. I think part of these conversations about globalization and localization, it's going to be more expensive if everything's local, right? And so it'll be really interesting to see. But, my firm idea is like, don't go out of your way. Don't, sit on a whole bunch of cash. Like have your emergency fund. Always have your emergency fund. But don't feel like you need to double your emergency fund. Don't go out and buy gold because you're worried about a world war. Don't, do those things. Whatever your plan was before, stick to your plan. And, really it comes to this idea of stay calm and rebalance.